Joining us right now is Stephen Auth. He is Federated Investors Chief Investment Officer. Stephen, good to see you.
Good to see you, Maria.
Give us an outlook for 2018.
We're pretty excited about 2018. Not as good as this year, but we've got a 3,000 target on the S&P, which would be 12-13% off these levels. We think all the key drivers are in place for another good year. We've got very good earnings. We think next year maybe around 150 on the S&P. The tax cut, I think, improves productivity and lengthens the cycle. So we've got pretty good economic growth next year. We're ahead of consensus there. We think the Fed's going to be relatively dovish, which we think will be supportive for the markets. And you know, the earnings numbers look pretty solid to us. So all in all, we're thinking it's going to be a pretty good year next year.
I agree with you, Stephen. And a lot of people, experts, will say that the market can't continue, which I hate to hear because there are no rules, or I haven't found them anyway. So I think it can continue. But I think one thing that's really helped get us here and had this great year that we've had in 2017 is the rollback of regulation. I don't think it gets talked about enough, not just as it relates to the big banks, but industry-wide. I think the rollback of oppressive regulations has really helped.
You know, everyone has the wrong framework, but the regulation thing has been completely underappreciated by
Not here. We talk about it every day.
Now, you guys have got it. It's true. And you know, when I talk about
before the election,
I talk about tone at the top. When you've got the head regulator, if you will, handing out gold stars and promotions for every corporate scout that gets brought in the office by some regulator, you get a lot of excess regulation. The impact is already being felt. The tone at the top has changed. The regulatory environment has come off. And we've put out 2-3% quarters in a row. We're going to put a fourth one out here, our third one out in Q4. We're at 3% next year. So I think you're absolutely right, Mike, that just the force of deregulation and confidence enhancement has given the economy a lift, and we're seeing it in the earnings.
So let me just ask you on earnings growth. 11% profit growth in 17 is what S&P is predicting. You think we'll get, what, 16, 17% earnings growth in 18?
We're a little ahead of that, Maria. We think we're going to end this year around 133, 134. We're at 150 for next year.
All right. Dave, what were you saying?
No, I was just going to ask about the Fed. 3 rate increases this year as of yesterday, 3 more penciled in for next year, but it looks like the Fed is underestimating what the rollback in regulations and what the tax reform policy will do. Their growth estimates for next year went up 0.4% to just 2.5% in the U.S., which is in line with Goldman Sachs, but longer run, 2%. It may be even worse. Are they underestimating? Because, again, if they underestimate and are too dovish for too long, there's a danger in that.
I think they are. The Fed is underestimating the growth impact long term, perhaps, of this tax package. But they've been underestimating even the impact of regulation, you just said all along. I mean, I thought Yellen's resignation speech was a Jackson Hole when, you know, she basically made a big push on the regulatory side. And if you think about what's gone on at the Fed, the capital markets division has been holding rates down to try to get the economy lifting, but the regulatory side has been really tough on the economy. Trump got the change he wants there. Powell's going to tone that back. I think he's going to be dovish on rates. I think he's going to kind of pull the balance sheet in a little quicker, which will help give us a little lift to the yield curve, which will be good for the banks and the economy. So, yeah, I was glad that the Fed didn't come out real harsh yesterday on a big economic improvement, because I think the one risk to this economy and to the market is if you get an unexpected, aggressive move by the Fed on hiking rates. And I think that's the bear case. We don't see it happening because we don't see it in the numbers.
I'm not a buyer of this, but a lot of people bring up the fact that typical recoveries only last 7 or 8 years. What are we, in the 9th year right now?
Maria, I put out a piece last summer called The Long Cycle. Yeah. Because I get all these economists come through my office, and I started at the beginning of the summer telling them, listen, can you give your presentation without using the word cycle? Maybe 5 minutes I could get through it. Because there's only been 12 expansions since World War II. Right. Each of them has been very different, with different lengths of time and different drivers. This one is very unusual. You just can't take an average and call it a cycle. Okay. So there's no circadian rhythm. Some people could say we've just started to expand. I mean, we've been through 8 years of very substandard growth. I think there's actually a good runway ahead for us.
Okay, so rallies don't die with age.
They usually die because the Fed kills them.
Okay, well, watch that then. Stephen, good to see you.
Good to see you.
Thank you so much. Stephen Auth there.